One of the questions I get asked most frequently is how much money should I put down? And my response is usually a question back, how much do you have? If you only have enough to do a 3% down payment, that's going to answer our question right there. But if you have enough to do 20% and still have 6 months in reserves, now it's a conversation of, okay, how much should you put down because you have options? If you're in a position where you don't have options, not much we can do. We can just find the home that's going to fit your cash to close needs. But for the rest of you who have some money to play with, let's explore what you should put down when buying a new home. Now, let's assume for this example that you're buying a primary residence, not an investment or a second home, and you're buying in the state of Vermont. Before we get started, make sure you like, share, and subscribe to my channel and hit the notification bell so you can see every video I post moving forward. So let's look at, first of all, what Google is telling us today's mortgage rates are. They're saying a 30-year fixed for Vermont with a 5% down payment, loan amount of $400,000, 800 credit score, 7.452. So that's what we're going to use in our example. We're going to assume the same for 20%. I think it is the same, it looks like. So we're going to come over here to this presentation that compares a 5% down payment and a 20% down payment. 5 and 20 just because they're easy to remember numbers, easy to work with. Technically, as a first-time homebuyer, you can go down to 3%. There are some other ways to go down to 3 as well. That can be another video. So first thing we're going to look at is obviously the loan amount. If you're putting 5 down, you're going to be borrowing more, so your loan amount is higher. We have that rate in here that we're pulling over from mortgage rates today on Google, 7.452. The payment in each scenario, the 20% down, you're saving $660 a month, and then the total cash to close, which includes your down payment and your closing costs. So right away, I think a lot of people are going to gravitate towards this number right here. You're going to save $660 a month by putting 20% down. That can be a car payment, right? Maybe 2 car payments, depending on what you're driving. A lot of flexibility with a monthly budget that frees up $660 a month. What you really want to look at, though, is that cash to close. The difference in cash to close is $74,567.82. So now we're going to look at it from that lens. Would you rather save $660 a month, or would you rather keep that $74,000 and change in your pocket? Something I like to do in this scenario is figure out what is the break even. If you're going to pay $74,000 and change to save $660 a month, at what point is that monthly savings going to recover that initial investment of $74,000 and change? In this case, it's going to take 112 payments, which is equivalent to about 9.5 years. Do you want to be recovering that initial investment over the next 9.5 years, or would you rather put the 5% down and then just pull $660 extra each month from that $74,000 that you now saved to make the payment more comfortable? And you can do that for the next 9.5 years. Now, keep in mind as well that we have PMI and the 5% down option. I'm just throwing a ballpark figure out there of 0.35% as a monthly factor. That'll vary depending on the home you buy and your actual credit score and down payment, blah, blah, blah. I'm just kind of using that as an estimate. You can look into more details on this presentation if you want to see what that looks like. But keep in mind, yes, that's more that you're just throwing out the window in cost. However, most people are going to refinance within a certain period of time that's usually before the 9.5-year mark, or they're going to sell the home. I think on average, most first-time homebuyers stay in their home about 6 years, roughly. If you're a second-time home buyer, you might be more like 10 years or more. Everybody's a little bit different. So the other thing to keep in mind is you can look at an amortization schedule. Now, if we assume 3% appreciation on your home every single year, and you're not making any extra payments and you don't refinance this mortgage, and you're just doing the 5% down option, then by the time you're at the 51st payment, which is in this scenario, April of 2029, okay, now we're going to assume that you're closing on this home in December of this year, 2024. So about 5 years from now, you're going to have 20% ownership in the home, and you could refinance and potentially get the PMI removed that way. So that's usually the exercise I go through with people to decide how much they should put down. Even those 20% down folks, if it really is comfortable, I mean, if they still have like 20% plus plenty of months in reserves, I usually say do it all day, right? You want to look at what you're going to have left over in the bank afterward, because when you buy a home, there's always something that you need a large sum of money for. For me, it was a lawnmower. I didn't realize for some reason that when I was buying a house with a lawn that I would need a lawnmower. It's just something that never crossed my mind until we actually moved in and I saw the grass get long and I was like, oh yeah, I need a lawnmower. Well, there's $2,000 right there because I wanted a nice one. So things just come up. Furniture, we replaced our flooring, boiler might break that passed inspection before, but who knows, something happened. You just always want to have some money in reserves. So in my opinion, putting less down is more comfortable because I prefer having that money in my bank in case I'm in a pinch. For some folks, they'd rather just have a nice monthly payment and they don't worry so much about what's in the bank. Personal preference, so keep that in mind. If you ever want to chat or have any questions, please reach out. Hope you have a great day. Bye-bye.